You know, you see that Constellation Brands logo, and maybe you just picture, I don't know, a bottle of beer or wine.
Right.
But what's really fascinating is the intricate financial engine driving a company this big and where they see themselves heading.
Mm-hmm.
So for this deep dive, we've got our hands on their latest investor presentation. This one's from April 9th, 2025.
Pretty recent, yeah.
Think of it as their roadmap for the next few years, fiscal 26 to 28. And, well, we're here to decode the key turns and, destinations.
Precisely. And it's not just looking backward, is it? I mean, this is about their projections, their ambitions, the
Exactly.
strategies they're laying out, and importantly, the potential potholes they're anticipating.
Right.
And we should probably mention, like they do, that whenever we talk about the future, these are forward-looking statements. There are always risks, uncertainties. Things might not pan out exactly as planned.
Absolutely. So our mission today is let's cut through the financial jargon, pull out the crucial bits.
Nope.
We want to understand the health and sort of the trajectory of their beer business and their wine and spirits divisions.
And what that means, yeah.
And what that could mean for the broader beverage market and ultimately for consumers.
Okay. And one of the first things that really jumps out is just the sheer amount of cash they expect to generate.
Yeah.
We're talking roughly $9 billion in operating cash flow
Wow.
and somewhere between $6 and $7 billion in free cash flow. That's projected just between fiscal 26 and 28.
That kind of financial power, well, it gives them a lot of options, doesn't it?
It certainly does.
And they've signaled pretty clearly what some of those options are. I mean, the presentation really emphasizes a commitment to returning value to shareholders.
Share buyback.
Yeah, including a significant $4 billion authorization for share repurchases. That kind of suggests they believe their stock is, well, maybe undervalued.
Or at least a good investment for their cash.
Yeah.
Yeah, shows
Yeah.
confidence. And if we kind of zoom out a bit, Constellation Brands is positioning itself as, a real growth story,
Well,
especially within the bigger CPG landscape.
so MPG, consumer packaged goods.
Right. They point to a pretty consistent track record. Top 10 growth leader for 12 years straight.
Impressive.
And number 1 for 6 of the last 8 years. That's according to that 2024 Circana report.
That kind of sustained performance, yeah, it's worth digging into. What are the strategic moves that keep them there?
Well, that's the big question, isn't it?
Is it maybe their laser focus on specific consumer groups? Or maybe something about their distribution, their network?
It's likely a mix, I think. A keen understanding of, what people want to drink, especially in beer, and a really effective strategy for getting those products onto shelves and into bars. Distribution and brand equity are huge assets for them.
Okay.
And underpinning their future plans, there are also some pretty significant efficiency drives, cost savings.
Ah, okay. How much are we talking?
They're aiming for over $200 million in net annualized cost savings across the whole company
By when?
by fiscal 28 through various restructuring efforts.
Okay, so let's take a look back then. Their recent performance. What did fiscal year 2025 actually look like in the books?
Okay, FY25. So sales-wise, they reported $10.209 billion in net sales. That's up 2% compared to FY24.
Okay.
Their organic net sales, which kind of strips out the impact of things like divestitures, were actually the same number, $10.209 billion. But that represents 3% organic growth.
Right. You have to remember they sold off their SVUDK vodka brand. That impacts the straight comparison. Yeah.
Exactly. Those strategic sales definitely shift the reported numbers.
Okay. Now, what about profitability in FY25? How profitable were they?
This is where you see a more pronounced difference between the reported figures and what they call comparable figures.
Okay.
Reported operating income was $0.4 billion. That's a big drop, 89% down compared to FY24.
Wow. Okay.
But their comparable operating income, which adjusts for certain, one-time items, that was much higher, $3.5 billion. And that was actually up 7%.
So those adjustments,
Yeah.
things like restructuring charges, maybe asset sale gains or losses, things that obscure the core business performance.
Precisely. And you see a similar thing with earnings per share, the EPS. Reported EPS was actually negative 0.25 cents.
Ooh.
Whereas comparable EPS was a much healthier $13.78.
Okay, so looking at those comparable numbers gives a clearer picture of the actual operational profitability.
That's the idea, yes.
And how much cash did the business actually generate during the year?
So in FY25, they generated $3.2 billion in operating cash flow
Okay.
and $1.9 billion in free cash flow. So, despite some of those swings in reported income, their ability to actually bring in cash remained quite strong.
Got it. Okay, let's dive into what many see as their, well, the powerhouse, the beer business.
Modelo country.
Yeah, exactly. How did their main beer brands do in FY25 in terms of sales to distributors? Depletions.
Right, depletions. That's the key indicator of consumer pull, how quickly distributors sell to retailers.
Okay.
Modelo Specials saw growth around 5%. Still going strong.
Still amazing.
Pacifico was a real standout, about 20% growth.
20%? Wow.
Yeah, even their Modelo Chelada brands collectively grew roughly 2%.
Okay. Any downsides?
Well, Corona Extra actually saw a decline, around 3%.
Okay, so a bit of a mixed bag, but mostly positive, it sounds like. Modelo and Pacifico really hitting the mark. Corona may be facing some headwinds.
Seems that way. Evolving preferences, maybe competition.
What about the profitability of the beer division overall?
Interestingly, the beer business operating margin actually increased in FY25. Got up to a very robust 39.7%.
39.7% margin? That's really high for beer, isn't it?
It's considered best in class, yes. So even with some shifts between brands, they're managing profitability extremely well.
Okay, so looking ahead now, fiscal 27 and 28, what are their expectations for beer?
They're projecting net sales growth in the 2% to 4% range.
Okay, moderate growth.
Moderate, but on a large base. And crucially, they're aiming to keep those operating margins strong, right in that 39% to 40% range.
And how do they plan to achieve that? What's driving it?
Several things. Getting their products into more stores, more restaurants, that's distribution gains.
Right.
A focused approach to innovation. So new packs, new liquids,
Okay.
and continued investment in marketing, keeping the brands top of mind.
So what are the key tailwinds they see for volume growth?
Yeah.
And maybe the potential drags?
The drivers, the tailwinds, are pretty much what we just said. Expanding points of distribution, successful innovation that clicks with consumers, and favorable demographic trends.
Yeah.
They seem confident there.
And the challenges?
Potential challenges.
Yeah.
Well, shifts in what people want to drink, obviously.
Yeah.
Increased competition. Those are always factors.
They specifically mentioned focusing on increasing availability for their core beer brands and their flavor and betterment brands. What's that distinction about?
It really highlights their sort of two-pronged approach.
Yep.
Prong one, make sure the flagships Modelo Special, Pacifico are everywhere. Maximize distribution.
Makes sense.
Prong two, grow the reach of the newer stuff. Things like Modelo Oro, their non-alcoholic options, the things catering to maybe different tastes, health trends, that kind of thing.
The betterment category, right.
Exactly.
And they made an interesting point about their disciplined approach to new products compared to some bigger competitors like AB InBev or Molson Coors. What's the message there?
Yeah, that was fascinating. They're basically arguing they're more strategic, maybe get more bang for their buck
That's
with
right.
each new launch.
How so?
They believe their core brand strength means they don't need to flood the market with tons of variations. They pointed out, I think, that their top 3 brands have significantly fewer individual product versions SKUs compared to the big guys.
Right.
Yet they generate more sales per SKU. It suggests, focus on quality over just sheer quantity in their innovation pipeline. Fewer bigger bets, maybe?
That sounds, well, more efficient. Potentially less risky, too.
Could be.
What about the costs? Running the beer business. Cost of goods, marketing spend. What are their expectations?
Okay, costs. They anticipate marketing spend as a percentage of sales to stay fairly steady, around 8.5%.
Okay.
Prioritizing spending behind those core brands, the flavor brands, and strategically investing in those betterment ones.
And cost of goods. Inflation must be a factor.
Oh, definitely. They expect to offset at least some of the inflation impact through savings and efficiencies, production, supply chain, that kind of thing.
And tariffs, that must be on their radar.
It is. They explicitly mention that their cost outlook does factor in the anticipated impact of those U.S. tariffs announced in early April on goods from Mexico.
Right.
But despite those pressures, the goal remains the same. Maintain those best-in-class operating margins, 39 to 40%.
Ambitious. And to keep up with growth, they must need more capacity, right? More breweries or bigger ones?
Absolutely. They're planning to add about 7 million hectoliters of production capacity.
Okay, how much is a hectoliter in, normal terms?
It's about 26.4 U.S. gallons. So 7 million of those?
Yeah.
It's a lot of beer.
Yeah, sounds like it.
This is planned between fiscal 26 and 28. Most of that expansion is happening at their big brewery down in Veracruz, Mexico.
Okay.
This should bring their total beer capacity up to around 55 million hectoliters by fiscal 28.
And that costs money, obviously.
CapEx.
big time. They're putting a huge chunk of their overall capital spending here, roughly $2 billion out of the total $2.4 billion for the whole company over those 3 years. That's earmarked for the beer business, for this growth and just maintaining existing facilities.
Okay, wow. That's a clear priority.
Very clear.
Now, let's maybe switch gears, talk about their wine and spirits business. Sounds like there's a pretty big strategic shift happening there.
That's right. It's quite a different picture compared to beer.
How so? What did FY25 look like for them?
Well, reported net sales for wine and spirits were down 7%. Organic net sales down 6%.
Ouch.
And operating income for this segment was $325 million. That's an 18% drop compared to the year before. Okay, so definitely a more challenging year for wine and spirits.
Yes, much more so than beer.
So given that, what's their outlook for FY27 and 28 in wine and spirits?
They're actually projecting net sales growth of up to 3%.
Okay, a turnaround.
And expecting operating margins to improve, getting into the 22% to 24% range.
That sounds better, but how?
Well, this positive outlook is really heavily dependent on successfully completing what they call their 2025 wine divestitures transaction.
Selling off some brands.
Exactly, a big sale. They expect it to bring in around $900 million in proceeds during fiscal 26.
Okay, $900 million. Which brands are actually being sold in this deal?
It involves some pretty recognizable names, actually. Woodbridge,
Yep.
Cook's, J. Roget, Simay, Robert Mondavi Private Selection,
Okay.
and Maomi, plus the vineyards and facilities associated with those brands in the U.S.
So these are mostly, what category would you put them in?
Primarily brands they see as being in the sort of declining mainstream or popular wine category, the lower-priced, high-volume stuff.
Gotcha. So this move clearly signals a strategic shift.
Absolutely. They're concentrating on the higher-end segments within their remaining wine and spirits portfolio, premium luxury stuff.
So we should expect a pretty significant change in the mix of what they sell in the coming years then.
Exactly. They're forecasting a really notable shift, both in the types of wine and spirits and also the channels they sell through. Like, the emphasis will be heavily skewed towards those higher-priced premium and luxury segments, also growing their direct-to-consumer sales
DTC.
and their international presence for these higher-end brands. They basically see the mainstream value wines becoming a much smaller piece of the pie.
How much smaller?
Get this, they estimate over 90% of their wine and spirits business will come from these higher-end segments by FY27, FY28.
90%. Wow. What was it in FY25?
Just 58%. So a huge shift.
That is a transformation. And are they also looking at cost savings here, like in beer?
Yes, they are. They're projecting additional restructuring will deliver over $100 million in net annualized cost savings within wine and spirits.
By FY28 again?
By FY28, yes. Coming from, cost of products, marketing, general admin costs across the board.
It really sounds like they're trying to streamline and focus that whole part of the business.
That's definitely the impression.
What about capital spending?
Sure.
Equipment, facilities, that kind of thing for wine and spirits. Is that changing too?
Yes, they're projecting a decrease there. CapEx for wine and spirits is expected to drop from about 11% of their net sales in FY25 down to around 7% by FY28.
Why the drop?
It probably reflects the fact that some of their recent big investments are maybe nearing completion. Things like hospitality, visitor centers, direct-to-consumer capabilities, especially for those higher growth brands they're keeping.
Okay, that makes sense. Let's step back then, look at the big picture again. How does Constellation plan to use its money, its capital, over the next few years? FY26 through FY28. Sounds like a lot of competing priorities.
They laid out their capital allocation strategy pretty clearly. A few key pillars.
Okay, pillar one.
First, organic investments. Putting money back into the core business to support growth, especially beer, obviously, and those higher-end wine and spirits brands they're focusing on now.
Right. Keep the engines running. What's next?
Second, maintaining a strong investment-grade credit rating. They're aiming for a net leverage ratio that's debt relative to earnings of around 3.0 times.
Which is generally seen as pretty healthy, right? Not too much debt.
Yeah, it's considered solid for a company their size, using debt strategically but not excessively.
Okay.
Third pillar, dividends. They plan to grow their dividend payments generally in line with earnings growth. They have a target payout ratio of about 30% of earnings annually.
Returning cash to shareholders that way. And then the buybacks.
Yep, that's number 4. Share repurchases, that $4 billion authorization we talked about earlier. Another way to return capital.
Okay. Anything else?
Finally, they mentioned being open to disciplined, smaller, strategic acquisitions. What they call tuck-in acquisitions, things that would complement what they already have, not huge transformative deals.
Got it. So with that roughly $9 billion in operating cash flow they expect, it sounds like they have the financial muscle to actually do all of these things.
It seems so, yes.
Mm.
They also laid out the total expected capital spending for the whole company, about $2.4 billion over those 3 years.
And most of that, as we said, is going to beer.
The vast majority, yeah. About $2 billion of the $2.4 billion.
It's also interesting you mentioned how their cash return stacks up against competitors.
Yeah. The presentation included a chart, though without naming names. It basically showed Constellation has been actively returning cash via both dividends and buybacks, and still has significant authorization left for more repurchases compared to an unnamed peer group in beverage alcohol.
Interesting comparison point. Of course, with any kind of projections, any forward-looking stuff, it's crucial to talk about the risks, right? The uncertainties. What did they highlight themselves?
Yeah, they were quite open about that. I mean, the standard disclaimer, but also specific points.
Like what?
Things like potential declines in consumer demand for their products. Their, significant reliance on the Mexican beer portfolio if something impacts that specifically.
Right, that's a big concentration risk.
Economic uncertainties internationally, potential for more tariffs, the outcomes of those big divestitures like selling the wine brand successfully and integrating the changes.
Yeah.
That's a key uncertainty too.
Makes sense.
Plus, the usual suspects. Competition, always fierce. Supply chain issues. Reliance on IT systems. Cybersecurity risks, always a concern these days.
Definitely.
Operational problems at breweries or wineries. And just broader geopolitical events that could disrupt things. It's a pretty comprehensive list of potential challenges.
And just to be clear, like you said earlier, we're just reporting what they highlighted as risks in their own materials. We're not, endorsing any specific viewpoint or predicting anything ourselves.
Exactly. Just conveying the information from the source.
Okay. So as we kind of wrap up this deep dive, what would you say are the most important things, the key takeaways from Constellation Brands' latest outlook?
I think the main takeaways really center on, first, strong cash generation. That's fundamental. Second, a clear differentiation in performance. The beer business is just this robust growth engine, continuing to outperform.
Right.
Third, a very deliberate, very strategic reshaping of their wine and spirits business.
Right.
Selling off mainstream brands to really focus on those higher margin, higher growth segments.
The premiumization push.
Exactly.
Yeah.
And underpinning all that is this disciplined approach to capital. Investing where the growth is and making sure shareholders get value back.
It really is striking, isn't it? That contrast between the sheer momentum in Beer Modelo Pacifico and this major strategic pivot in wine and spirits towards the fancy stuff. It almost feels like two different companies, strategy-wise, operating under one roof.
It does feel a bit like that.
Oh.
And, it kind of begs an interesting question for people to think about.
Oh, yeah.
Well, given these insights, given this strategy, what do you think the potential long-term impacts could be for the whole beverage industry landscape? As Constellation executes this plan, how might consumer habits change? How might competitors react? And, what unexpected hurdles or maybe even opportunities might pop up along the way as they navigate this?
Yeah, that's definitely... Well, it's certainly some food for thought.